Okay, let's unpack this. We're diving into Lennar's Q3 2025 results.
Yeah, one of the biggest home builders out there.
And these numbers show a pretty big strategic shift, right? Affordability's still biting.
Definitely. So the question is, is this the turnaround people wanted?
Or something maybe more complicated.
I'd say more complicated. It looks like they're playing a longer game now.
Prioritizing stability over just pushing volume.
Exactly. They hit some targets, sure, but it cost them. And now they're adjusting course for Q4.
Okay, let's start with the headline numbers then. Q3 financials. What did we see on earnings?
All right, so earnings per share, EPS, was $2.29.
But hang on, that includes some tech investment gains, doesn't it?
It does. Mark-to-market gains. If you strip those out, operational EPS was $2.
$2 flat, which
Yeah.
actually still beat what analysts were expecting, right? They were at $2.10.
Correct. So a beat on the adjusted EPS. Revenues landed at $8.8 billion.
Solid number, but just a hair under consensus. People were looking for closer to $9 billion.
Yeah, just slightly below that $9 billion mark.
Yeah.
So a bit mixed on the top line.
Okay, EPS beat, revenue slight miss, but the number everyone really watches.
Gross margin on home sales. Absolutely.
Yeah. And how did that look?
That's where the pressure really showed. Came in at 17.5%.
17.5, and the consensus was?
17.8%. So a miss there.
Doesn't sound like a huge miss, but in context.
Well, yeah. Compared to last year, Q3 2024, the margin was 22.5%.
Wow, okay, that's a 5-point drop year over year. That's significant erosion.
It really is. Management basically said, look, the market softened.
Meaning they had to push harder to sell.
Exactly. More incentives. And that, plus some price cuts, dropped the average sales price.
How much did the average price fall?
Down 9%. Landed at $383,000 per home delivered.
So in Q3, they clearly chose volume over preserving that margin.
That seems to be the story, yes. Which you can see in the volume numbers, too.
Right, let's look at those. New orders.
Look pretty good, actually. Up 12% year over year. Came in at 23,004 homes.
And that beat expectations.
It did, yeah, beat the consensus. But then you look at deliveries.
What happened there?
21,584 homes delivered. Now, that's basically flat compared to last year.
Okay, flat year over year. But analysts expected more.
They did. Deliveries missed analyst expectations. So they sold well, but maybe didn't quite close them out as fast as the street hoped.
Interesting. So success in generating orders, but a miss on deliveries and that crucial margin number.
Precisely. And that combo, keeping sales moving but taking the profit hit, seems to be what led to the big Q4 decision.
Let's talk about that. The forward guidance. This is where the strategy pivot really shows up.
Yeah, Executive Chairman Stuart Miller had a key quote.
What was it?
He said, we believe that now is a good time to moderate our volume and allow the market to catch up.
Moderate volume. That sounds like hitting the brakes gently.
It's definitely a signal they're cooling things off deliberately for Q4. You see it in the guidance numbers.
Okay, so what are they guiding for new orders in Q4?
They expect between 20,000 and 21,000 new orders.
And deliveries, that's the big one. Analysts watch for near-term revenue.
Absolutely. And that guidance is, well, telling. 22,000 to 23,000 homes.
How does that compare to what analysts were modeling?
It's way lower, significantly lower. Analysts were up around 25,587.
Okay, so a big cut to expected Q4 volume. But what about margin? Are they guiding that down too?
No, that's the point. They expect gross margin to hold steady, around 17.5%.
Ah, so stabilized margin, even if it means less volume, that is a pivot.
Exactly. They're drawing a line in the sand on profitability.
What does that 17.5% level tell us about the market? Is that like the new normal cost of doing business?
It might be, for now.
Yeah.
It's definitely lower than the piece we saw in 21-22. Those are well into the 20s.
Right.
And even pre-pandemic, maybe closer to 18-20% was more typical.
Yeah.
So 17.5 feels like, okay, this is the floor in a tough market. We won't chase volume below this.
And some analysts actually saw this move by Lennar as a positive thing for the whole industry.
Yes, some did. Wedbush, for example.
Yeah.
Their take was interesting.
What'd they say?
They pointed out that Lennar, being so big, their strategy kind of sets the tone. And their previous volume over price approach might have been hurting margins for everyone.
So Lennar pulling back might ease price competition across the board.
That's the idea. Could give smaller builders some breathing room. So maybe good news for housing overall, as Wedbush put it.
But isn't there a risk? If Lennar slows down, don't they just lose market share?
It's a calculated risk, yeah. But Lennar's probably betting on their scale and efficiency,
Meaning they think they can stabilize now, ride out the storm?
and then ramp back up quickly when things improve, because they've built this huge operational machine.
And that hope for improvement is tied to interest rates, isn't it?
Absolutely. Rates were high in Q3, but started ticking down near the end.
Plus that recent Fed rate cut management mentioned.
Right, so there's some optimism that maybe the worst of the rate pressure is easing, which could help bring buyers back without needing quite so many incentives. They're waiting for that buyer.
Yeah. Okay, let's dig into that operational machine you mentioned. How did they manage the Q3 volume they did get, even with the margin hit? Sales pace was still pretty strong.
4.7 homes per community per month, yeah.
How'd they do it?
Aggressive, targeted incentives. Really focused on that affordability crunch.
Things like mortgage rate buy-downs?
Exactly. Co-CEO John Jaffin mentioned those specifically, but it comes at a cost.
How much did those incentives cost?
They rose to 14.3% of the average sales price in Q3.
Wow, think about that. Almost 15 cents of every sales dollar going right back out as incentives.
Yeah, it shows you how tough the environment is. And it perfectly explains why that margin dropped to 17.5%.
But you said there's another side to it, efficiency gains.
Right. They aren't just throwing money at the problem, they're getting incredibly efficient internally, operating like a true production machine.
What kind of efficiencies are we talking about?
Cycle time is a big one, how fast they build a house. Shortest cycle time in company history for single-family homes, just 126 calendar days.
126 days, that's fast.
Incredibly fast. And that's the 11th quarter in a row they've reduced it. Turning inventory quickly saves money, reduces risk.
And that speed helps them use their size effectively.
Precisely. They maintain this production-first approach. Kept starting homes at a good pace, 4.4 per community per month.
Why keep starting homes if the market's tough?
Because that consistent volume lets them lean on their suppliers and trade partners, negotiate better costs.
Did it work? Did costs come down?
Yes. Direct construction costs were down about 3% year over year, lowest level since Q3 2021.
So losing margin on the sales side with incentives.
But clawing some of it back through production efficiency and lower build costs, it's a balancing act.
And this full approach is underpinned by their land strategy, right? The asset-light model.
Absolutely key. It gives them the flexibility to, pull that hand on volume like they're doing now.
How does that show up in the numbers?
Look at the land they actually own. Home sites where their capital is tied up.
Okay.
Supply down to just 0.1 years worth.
0.1. Like enough for a few weeks.
Basically, yes. Compare that to a year ago, it was 1.1 years.
Huge shift. So where's the land coming from then?
It's controlled land. Held through options, land banks. That's up to 98% of their supply now versus 81% last year.
And the benefit of that is?
Flexibility.
Yeah.
Massive flexibility. If the market gets worse, they're not stuck building on expensive land they own. They can pause deals, maybe even walk away. Huge advantage in volatile times.
Got it. Less capital tied up, less risk. That focus on cash flow also seemed to help their financial services arm.
Yeah, that was a bright spot. A nice counterpoint to the home building margin pressure.
How did financial services do?
Operating earnings were up nicely. $177 million compared to $144 million last year.
What drove that increase?
Mainly higher profit per locked loan. Basically, better margins in their mortgage business on the secondary market.
Interesting. So spending money on buy downs on one side, but making more margin on the actual mortgage origination on the other?
Kinda, yeah. They were capitalizing on the higher rate environment within the financial segment itself.
Okay, now connecting operations to the longer-term view, technology. This quarter had some big numbers related to their tech investments.
It did. A $99 million mark-to-market gain, just from their strategic tech stakes.
$99 million. Remind us what mark-to-market means again. It's not actual cash profit, right?
It's an accounting thing. Reflects the current perceived value of those investments based on market prices. But it shows those bets are looking pretty good on paper right now.
Which investments were the big drivers?
Opendoor, that sticker open, was the biggest chunk, $71.3 million gain. And Hippo, HIPO, added about $27.7 million.
So they're betting not just on building homes, but on how people buy and sell them in the future, using technology.
Definitely. And management confirmed they're still investing heavily in their own Lennar technology solutions.
Even though it costs them money right now. Adds to expenses.
Yeah, they noted it adds to SG&A that's selling general and admin costs.
So it's an operating drag currently.
A slight one, yes. But they clearly believe the long-term payoff is worth it. They see tech as transformative.
The chairman quoted Opendoor CEO on that, didn't he? About making the process.
Less frictionful so more people do it. That was the gist. Using AI, modern tools.
The vision seems clear. Use tech to boost affordability, simplify things.
Make it easier, faster, maybe cheaper to transact. That could unlock demand in a way that just waiting for rates to fall might not. It's about structural cost reduction.
Makes sense. Now, while they invest long-term in tech, what about the short-term capital structure? Any aggressive moves there?
Well, they kept buying back stock, repurchased 4.1 million shares in Q3, cost them about $507 million.
Okay, returning cash to shareholders, what about debt?
That's where there was a noticeable shift. Home building debt to total capital jumped up
How much?
to 13.5%. A year ago, it was only 7.6%.
Whoa, nearly doubled the leverage ratio in a year. Is that a red flag?
Maybe not a red flag, but it's worth noting. Given their asset-light model, they don't have tons of debt tied to land itself.
So this new debt is likely for...
Probably funding share buybacks, maybe some strategic investments. It's likely cheap capital. It moves them away from being almost debt-free, but their cash flow is strong. Seems manageable for now.
Okay, so let's pull this all together. What's the main takeaway for you listening to this?
I think the Q3 results really showed how tough it is to chase volume and hold margin when rates are high and affordability is squeezed.
It's a trade-off they couldn't sustain without pain.
Right. So the Q4 guidance, that pullback on volume, it's a deliberate pause. They want to stabilize margins at that 17.5% floor.
Before trying to speed up again.
Exactly. But that reacceleration depends heavily on the market cooperating, specifically mortgage rates.
They're betting that if rates get closer to 6%, maybe lower, demand will pick up enough.
Yeah, the immediate pressure is clearly price and affordability.
So that brings us to the final thought, the provocative question, maybe.
I think it comes down to this. We see these big tech bets, like the Opendoor games. Can that technology really deliver the structural cost savings and the long-term affordability the housing market needs?
Enough to overcome the chronic supply shortage.
Right. Or are we just going to be stuck watching interest rates? Will short-term rate swings keep dictating everything for builders like Lennar, forcing this constant choice between volume and margin?
Tech revolution versus rate volatility. Which force wins out?
That's the tightrope. They, and frankly the whole industry, are walking to 2026. Something for you to mull over.